There is a single statistic released monthly by the Commerce Department that rarely makes headlines, yet it reveals more about the true financial state of American households than any stock market index, unemployment figure, or quarterly GDP report ever could. That number is the personal savings rate, the portion of after-tax income that Americans actually set aside instead of spending. Back in March of 2021, at the height of pandemic-era stimulus, this rate soared to 21.6%. Households were socking away more than 1/5 of every dollar earned, creating a financial buffer so substantial that economists debated where all that extra cash would eventually flow. Fast forward to February of 2026, the latest Commerce Department data shows this rate has plummeted to 4%. Not 4% below the pandemic peak, but 4% outright. Over 5 years, savings as a share of income fell 17.6 percentage points, marking the largest sustained erosion of American household financial resilience since World War II. Analysis in April of 2026 warned that Americans who still have money in savings accounts should pause and fully grasp the implications of this number before making any financial moves. Unlike in 2022, when savings were still bolstered by government stimulus, emergency student loan pauses, and other pandemic relief measures, households today are increasingly borrowing just to get by, struggling to keep up with payments. One economist explained it with professional precision. Households now have far less of a cushion than 2 or 3 years ago. Well, less of a cushion, a polite phrasing for what ordinary people would simply call being broke. Pandemic savings are gone. Stimulus checks are gone. Student loan relief is gone. Federal Reserve rate cuts meant to ease financial stress are not coming, as the Iran war energy shock has already pushed inflation up to 3.3% and climbing. Gas prices have surged roughly 30% from late February levels. The Bankrate Emergency Savings Survey released in February of 2026 found that 53% of Americans are saving less for emergencies due to rising prices. Meanwhile, 29% of households now carry more credit card debt than they have in emergency savings. This is not limited to lower-income families. It spans all income brackets, all age groups, and all household types. Right now, nearly 1/3 of American households face a situation where high-interest debt outweighs any accessible savings. What makes May of 2026 especially critical is the convergence of forces threatening the depletion of these remaining savings. The mechanism that drains household financial cushions operates in 4 overlapping stages, each one significant on its own, but together creating an unprecedented pressure this month. The first stage is the relentless inflation tax. Consumer prices in the U.S. have climbed 26% since December of 2019, according to CPI data in the Bankrate 2026 report. That figure is not measured from the inflation spike of 2022, but from the pre-pandemic baseline every household budgeted against. A family earning $70,000 in 2019 that still earns $70,000 today effectively buys 21% fewer goods and services per paycheck than 5 years ago. While wages remain nominally the same, inflation has functionally delivered the equivalent of a 21% pay cut. Grocery bills, utilities, insurance, gas, meals out, daycare, and rent have all risen faster than wages every single year for 5 consecutive years. This relentless cost escalation explains why the national savings rate has collapsed from 21.6 to 4%. Households are forced to spend more on necessities, leaving far less available to set aside. Adding to this, the Iran war energy shock that began on February 28, 2026, introduced a sudden spike in gasoline prices, nearly 30% nationwide. Every state experienced double-digit increases. A family that paid $350 per month for gas before the war now spends roughly $455, an additional $105 monthly. Over a year, that equals $1,260, nearly 45% of a $70,000 household's total annual savings capacity of roughly $2,800, before considering any other inflationary impacts. The second stage is the ongoing credit card debt cycle that has continued since pandemic savings dried up. The Federal Reserve's G19 Consumer Credit Report, released on April 7th, 2026, shows total outstanding revolving credit, mostly credit card balances, has reached $1.33 trillion. Surveys reveal that 1 in 3 Americans now relies on credit cards for everyday necessities, not for luxuries or entertainment. The proportion of households carrying balances over $10,000 jumped from 23% in 2025 to 29% in 2026, the largest annual increase in 3 years. At annual percentage rates between 21 and 24%, a $10,000 balance generates roughly $2,200 in interest alone each year, before even reducing the principal. This is money flowing directly to credit card issuers with zero return, zero equity, and zero reduction in financial vulnerability, essentially renting money at 22% interest and receiving nothing in return. The third stage is the silent surge in insurance and other essential costs often overlooked because many of these expenses are billed annually or quarterly. Homeowners insurance has risen about 31% since January 2020. And in high-risk states like Florida, California, and Louisiana, premiums have climbed 60, 80, or even over 100% due to increased climate events and higher replacement costs under persistent inflation. A household paying $3,000 annually in 2020 now faces premiums between $3,900 and $6,000 in 2026, depending on location. Auto insurance followed a similar path, increasing 22% on average, with a household paying $1,500 in 2020, now paying around $1,830. Employer-sponsored health insurance plans rose approximately 20% over the same period, with employee contributions scaling accordingly. Combined, homeowners, auto, and health insurance hikes have added $2,000 to $4,000 in non-discretionary annual costs that must be absorbed before other expenses. The fourth stage is the high interest rate environment reshaping the cost of all floating rate debt. The federal funds rate, hovering between 3.5 and 3.75%, is the highest in more than 15 years. Adjustable rate mortgages issued at near zero rates in 2020 and 2021 have already reset or will soon reset at these higher rates. Home equity lines of credit tied to prime plus spread are now far more expensive. Small business lines of credit at floating rates consume more monthly operating cash flow than they did under near zero rate conditions. The compounding effect of inflation, credit card interest, insurance spikes, and elevated borrowing costs is forcing households in May 2026 to confront a stark choice: either drain their savings to maintain current living standards or adjust spending in ways that effectively reduce real wealth. The last historical parallel occurred during the consumer financial crisis of 1974 and 1975, when households faced an energy price shock, high interest rates with no cuts in sight, declining real wages, and a credit market tightening against inflation. History shows that when these forces converge simultaneously, household savings can vanish rapidly. In the early months of 1973, the personal savings rate in the United States hovered around 9%. By the close of 1974, that figure had dropped to roughly 5%. Households that had entered the energy crisis believing their financial cushions were sufficient discovered those cushions rapidly evaporating under the combined weight of soaring gasoline expenses, food inflation fueled by energy costs, and rising payments on adjustable rate mortgages, resetting higher as the Federal Reserve raised interest rates to combat inflation. The stagflation of the mid-1970s created the precise savings depletion dynamic economists identify as a key trigger for the consumer spending collapse that deepened the 1975 recession. Families that initially absorbed inflation using their savings eventually exhausted that buffer, halting spending, not out of choice, but because the funds were simply gone. The direct parallel to May of 2026 is not in the nominal inflation level, which was higher in the 1970s, but in the structural pattern of savings erosion. The pandemic-era savings that once served as a buffer, much like the savings cushions of the 1970s, have been drained from a 21.6% peak to just 4%. The Iran war energy shock, playing the role historically filled by the OPEC embargo, has driven gasoline prices 30% higher in merely 6 weeks. Meanwhile, the Federal Reserve, caught between its inflation and growth mandates, mirrors the position Arthur Burns's Fed held in the mid-1970s. Households witnessing their savings diminish while carrying credit card balances at 22% annual interest are effectively reliving the 1974 experience in 2026. A second historical indicator is the depletion of excess savings in 2023, documented by the San Francisco Federal Reserve Bank. Their analysis concluded that the roughly $2.1 trillion in excess pandemic savings were entirely exhausted by October of 2023, completely spent, leaving no buffer. Families who had relied on government stimulus held in their savings accounts reached the end of that reserve in October 2023, forcing them to cut spending, turn to credit cards, or both. Credit card data from 2023 through 2025 confirms the choice. Households relied on credit. Revolving credit, which was around $770 billion in the first quarter of 2021 at the pandemic savings peak, steadily climbed to $1,277 billion by the fourth quarter of 2025, a 66% increase in less than 5 years. The gap between income and the spending needed to maintain living standards was bridged entirely with credit card debt at 22% interest. The typical household in 2026 now begins from an even more vulnerable starting point than those in 2023, who had just depleted their pandemic savings. They have already replaced those savings with credit card debt, carrying less liquid wealth and more liabilities in a context of rising inflation and elevated interest rates, at the very start of the year's most financially precarious month. A third historical parallel is the accelerated savings depletion of 2022, preceding the consumer spending slowdown in late 2022 and 2023, when the Federal Reserve embarked on its most aggressive rate hiking cycle in 4 decades beginning March of 2022. Rapidly rising credit card interest, accelerating mortgage costs on adjustable rate loans, and persistent inflation that rate hikes could not immediately resolve inflicted a 5-pronged assault on household budgets. The savings rate plummeted from approximately 8% in early 2022 to roughly 2.3% by September 2022 as households absorbed higher mortgage payments, steeper credit card interest, and rising costs for essentials. Recovery was modest through 2023 and 2024 as pandemic-era excess savings were slowly converted to spending, supported by a labor market sustaining nominal wage growth. By February of 2026, the national savings rate of 4% reflects a halt in the recovery from the 2022 depletion. At the same time, the Iran war energy shock continues to exert downward pressure through elevated gasoline prices, while the Federal Reserve transition on May 15th removes the market's last expectation for a rate cut relief. Applying the full savings drain mechanism to May 2026 requires precision. May becomes the most dangerous month for household savings for 4 intertwined reasons, each peaking in 2026. First is the summer spending inflection. May marks the seasonal acceleration of discretionary spending toward the summer months, historically the highest spending period for travel, entertainment, clothing, home improvement, and outdoor recreation. Households that managed modest winter and spring budgets now confront natural seasonal pressures before any corresponding seasonal income. The already tight 4% savings rate through February and March faces additional strain from Memorial Day travel, summer camp deposits, vacation prepayments, and behavioral increases in spending prompted by warmer weather. In 2026, with gasoline 30% higher than at the year's start, and hotels, airlines, and entertainment venues repricing post-pandemic, the May spending surge hits a budget with no room to absorb it without drawing on savings or adding to credit card balances. Second is the spring property tax and insurance cycle. Approximately 65% of American households own their homes and pay property taxes directly or via mortgage escrow. April and May bring property tax assessments and escrow adjustments. In markets where property values climbed significantly over the past 5 years and insurance premiums rose 30% since 2020. Annual escrow analyses by mortgage servicers trigger shortage notifications. Homeowners must either pay the deficit in a lump sum or accept increased monthly mortgage payments, covering both the repayment and projected future costs. A homeowner with a $2,800 monthly mortgage from 2020 or 2021 could see new payments of $3,100 or $3,200, an immediate $300 to $400 monthly increase unbudgeted for the year. Third is the May 15th Federal Reserve transition, the so-called double whammy. On that day, Jerome Powell steps down and Kevin Warsh assumes the chairmanship. Markets immediately reprice rate expectations, which ripple to all floating rate financial instruments within days. Credit card rates tied to prime will reflect the higher for longer signal communicated by Warsh's appointment and his public record. Banks extending credit at 22 to 24% will adjust new rates accordingly. Consumers bridging the gap between income and essential expenses with credit cards will encounter higher borrowing costs precisely as seasonal spending pressures arrive. Fourth is the labor market anxiety, creating precautionary saving paralysis, highlighted in the 2026 bank rate survey. The unemployment rate at 4.4% and rising instills fear in households with primary earners vulnerable to AI disruption or economic slowdown, as documented in the software, retail, and commercial real estate sectors. These households hesitate to spend savings on summer activities, conserving funds against potential job loss while relying on credit for non-deferrable essentials. The result is the behavioral signature of households maintaining the appearance of savings while credit card balances silently grow. This is how the May savings drain operates, not through a single withdrawal, but via the accumulation of credit card charges whose interest quietly erodes the savings balance, a balance growing at 22% annually, while the savings balance earns 3.5% automatically consumes household net worth at roughly 18.5 percentage points per year on every dollar that sits simultaneously in savings and on a credit card. Immediate action in May 2026, before the summer spending surge, escrow adjustments, Fed repricing, and credit card interest accumulation, requires 5 concrete decisions any household can implement in 72 hours without special expertise, risky investments, or major life changes. The first critical step is compiling a complete inventory of all credit card balances, corresponding annual percentage rates, and minimum payments across all accounts. This is not general awareness. Each specific account, balance, rate, and minimum must be documented together to reveal the true annual cost of carrying the debt. For example, a family holding an $8,000 balance at 22% APR pays roughly $1,760 in interest annually, about $147 monthly before reducing the principal. That $147 flows invisibly out of the household's finances, embedded in the minimum payment rather than shown as a separate line item. When the minimum payment is made, the checking account reflects the total, but the portion directed to interest is not explicitly visible, masking the silent erosion of wealth. Making the actual annual cost of credit card interest visible is the first and most crucial step. Transforming an abstract percentage into a tangible dollar figure allows households to compare it directly against other expenses and prioritize effectively. The second step is identifying the single debt with the highest interest rate and calculating precisely how eliminating it would improve monthly cash flow. Consumer surveys in 2026 show the average American credit card balance ranges between $3,000 and $5,000. A household carrying $5,000 at 23% annual interest pays roughly $1,150 each year in interest alone. Eliminating this debt in full, whether by liquidating a low-yield savings account, earning 3.5% annually, or redirecting 3 to 4 months of discretionary spending that is less valuable than the interest being avoided, produces immediate and lasting financial relief. A $5,000 savings account earning 3.5% yields $175 annually, while a credit card charging 23% on the same balance costs $1,150. Carrying both simultaneously imposes a net cost of $975 per year, or $81.25 per month. Moving $5,000 from a low-yield account to wipe out a high-interest credit card is not a depletion of savings. It is the conversion of low-return assets into the elimination of costly liabilities, offering the highest guaranteed return available at any moment in any financial market. The third step involves the concrete identification of the 3 most expensive, non-essential monthly subscriptions and canceling them before the summer spending surge. The average American household maintains between 15 and 20 active subscriptions, including streaming video, music services, cloud storage, gaming platforms, fitness apps, news subscriptions, meal planning services, and other software, many initiated during the pandemic and no longer actively used. Monthly costs for these subscriptions typically range from $150 to $250 per household. In the May 2026 financial environment, each dollar saved from cutting subscriptions either remains in the household savings account or reduces credit card balances accruing 22 to 24% annual interest. Canceling 3 $50 subscriptions does not merely save $150 per month. It is $150 either earning the savings rate or avoiding high-cost debt, amplifying the financial benefit. The fourth step is a detailed review of all automatic payments and recurring charges processed through the household's checking account or credit cards. Most American households in 2026 have automatic payment structures established at various times at different rates and for purposes that no longer align with current priorities. Gym memberships initiated at promotional rates that have escalated, insurance coverage not renegotiated at renewal, or bundled cable and internet services including unused components all drain resources. A systematic review of these recurring charges, accessible through banking apps and transaction histories, identifies exact amounts and vendors extracting funds without an active monthly decision. For a household operating at a 4% savings rate in a cumulative 26% inflation environment, eliminating $200 in unnecessary automatic payments equates to roughly a 3.4% pay raise, a tangible improvement in monthly cash flow. The fifth and final action is a specific assessment of exposure to the May property tax and insurance adjustment cycle. Homeowners with mortgages that include escrow accounts should request the most recent escrow analysis from their mortgage servicer, ensuring the report reflects current property tax assessments and insurance premiums. The typical May escrow adjustment notification, which may increase monthly payments by $300 immediately, need not arrive as a surprise. Households informed in advance can adjust their budget proactively in April rather than facing constrained financial flexibility in May. Minimizing arguments against the urgency of these steps merit careful scrutiny. The most common claim is that a 4% savings rate is not alarming because aggregate household net worth remains near record highs, according to the Federal Reserve's Flow of Funds report. While true at the aggregate level, this observation is deeply misleading regarding distribution. Wealth concentration among the top 20%, whose assets in real estate have soared as the savings rate collapsed, inflates aggregate net worth figures. The bottom 60% of households, however, hold roughly 6% of total wealth. The savings rate collapse from 21.6% to 4% reflects the middle 3 quintiles, households earning between $30,000 and $150,000 annually, whose budgets are genuinely strained by 26% inflation, elevated credit card rates, surging insurance, and the Iran war energy shock. These households are experiencing the specific depletion documented by the 4% savings figure. A second minimizing argument cites rising wages, suggesting households earn more nominally, mitigating financial stress. While accurate regarding nominal wage growth, this perspective ignores the math of savings strain. A household earning $65,000 in 2020 and $75,000 in 2026 has enjoyed a 15.4% nominal increase. Over the same period, consumer prices rose approximately 26%, meaning real purchasing power fell by about 8.4%. Higher nominal income does not offset rising nominal costs. It only increases the absolute dollars spent on the same essentials, leaving less for savings despite larger paychecks. A third argument claims the current stress is temporary, resolving once the Iran war ends, oil prices normalize, and the Federal Reserve cuts rates. While correct regarding eventual resolution, this is misleading regarding the timeline. Ray Dalio, speaking in late April 2026, confirmed the stagflation characterization. Stagflation is a prolonged phenomenon. In the 1970s, it lasted roughly 7 years from the OPEC embargo of 1973 to the structural resolution beginning in 1980. Households draining savings in May 2026 cannot wait 7 years for relief. Immediate, deliberate action determines whether any financial cushion remains when the resolution eventually occurs. The synthesis of the complete savings drain mechanism reveals that household decisions in May 2026, rather than June or July, dictate outcomes. Summer spending surges, adverse rate signals, escrow adjustments, and credit card interest compounding act together, amplifying financial strain if action is delayed. Pandemic-era savings were fully exhausted by October 2023, replaced by 22% interest credit card debt totaling $1,330 billion in revolving credit. A 4% savings rate represents roughly 43% of the $3,000 to $4,000 in annual savings capacity available to an average middle-income household, before gasoline price spikes from the Iran war, property tax escrow adjustments, summer spending, or elevated floating rate debt costs. The 53% of Americans reporting reduced saving due to inflation and rising prices are describing a structural financial shift, not a temporary inconvenience. The convergence of pressures in May 2026 is at its peak. 47% of Americans cannot cover a $1,000 emergency without borrowing one unexpected car repair, medical expense, or home appliance failure away from increasing already high-interest credit card balances. 29%, with more credit card debt than emergency savings, are in a configuration where each month of the current environment simultaneously increases debt and reduces savings unless households act decisively. The phrase, "act now," is not hyperbole. Each week in May increases seasonal spending pressure, entrenches the worst rate signals in credit markets, compounds gasoline costs, and narrows the window for preserving financial cushions. Compiling credit card balances and rates, eliminating the highest cost debt, auditing subscriptions and automatic payments, and reviewing escrow adjustments are not complex strategies. They are tangible household-level actions, transforming the abstract understanding of a savings drain into concrete measures that determine whether a household enters June with any financial buffer intact or confirms the prediction of the 4% savings rate. Thanks for watching. See you in the next one.